So China's treasury dump is getting worse, but they are rookies compared to America. The real takedown is coming from Janet Yellen and not Xi Jinping. And let me make it easy to understand. When it comes to blowing up the treasury market, Beijing is a novice. Why? Because China can only sell a limited amount of treasuries and they can only do it over a long period of time. You can only sell what you have, but America itself can sell an unlimited amount of debt whenever it wants. And we need to talk about this because going forward, there will be a global flood of treasuries circulating the world. Demand is going to come down because China and friends aren't buying. Plus, the supply is about to go bonkers because America is borrowing money like no tomorrow. In our lead story today, China cuts US Treasury holdings to 14-year low amidst persisting security concerns and geopolitical tensions. Their holdings of US debt have dropped by $11.3 billion, taking it down to just 835 billion. And this means there's additional $11.3 billion worth of treasuries floating around. And this pushes up bond yields because now the supply of treasuries have increased. Simple enough to understand, right? And if we zoom out, we can see the total treasury dump from China amounts to $103 billion since a year ago. Now, that is a sizable amount, and the consistency of the dump tells us that China has lost confidence in Washington. There's just too much geopolitical risk in holding US bonds. But let's get real here. Flooding the market with 100 billion over 12 months is nothing compared to what Janet Yellen can do. China is playing with rookie numbers compared to the US Treasury themselves. And since the debt ceiling was suspended back in June, the US Treasury has borrowed $1 trillion in a single month. Do you know how insane that is? Yellen flooded the market with $1 trillion worth of bonds, 10 times the amount of China's treasury sales within 30 days. Washington essentially sold bonds 100 times faster than Beijing. We have said it a million times. The biggest threat to the US bond market really isn't China, it really isn't Russia, but America itself. And here's the big problem: sooner or later, we'll be facing a fiscal cliff where it is simply impossible to borrow anymore. And if we look at the Fed's own data, the interest payment on the debt alone is almost $1 trillion a year. And this pushes America closer towards default because this number is about to go much higher. And just wait until the existing debt matures and rolls over to a higher interest rates. And once that happens, you'll see interest payments just explode up. But let's focus a little more on China. Yes, they aren't dumping as much supply as Yellen herself, but this is still a big economic shift. What we are witnessing is a big customer of US Treasury shifting away. They can't dump everything because they still trade with the United States, but they definitely won't be buying more bonds like before. There are two big shifts happening in China that we need to understand. And these are structural shifts that won't stop, will only get worse. Remember all those sanctions against China, the ones that restrict chips and tech imports? Well, because of that, China is shifting their consumption towards the domestic market. They're going to buy more stuff within their own country. Beijing recently issued 20 measures to boost their domestic consumption. One key driver is to ramp up auto sales. And for the first time, Chinese car makers are taking back the majority of the domestic market. Chinese cars are being bought more than foreign brands from locals, and that's even during the property crisis. According to ING Bank, China's domestic economy is thriving, but their exports are dropping. During the Golden Week holiday, retail sales went up by 20% and internal tourism rose by 40%. And this is an important fact that we can't gloss over. The domestic economy is booming, but foreign consumption is crashing. In July, Chinese exports to both the US and the EU fell. Exports dropped by 23% to the United States and 20% to the Eurozone, but China's GDP is still averaging around 4 to 5%, and this means their domestic economy is growing and strong enough to support a positive GDP. And when China sells things locally, they sell in the Chinese yuan, not in dollars. So revenues in dollars are dropping, and that means a lesser need for the government to hoard the reserve currency, and that impacts the amount of US treasuries China needs to hold. As their domestic economy grows, the amount of US treasuries needed starts to shrink. Demand for US bonds from China will fall because it just isn't necessary anymore. But that's just the tip of the iceberg. Another structural change is China's move to dump their dollars for oil and gas. Now, China recently signed a 27-year LNG deal with Qatar worth $60 billion. They are prepaying for their energy supply, earmarking a ton of dollars and getting rid of them for commodities. They are treating the dollar like a hot potato. They are passing them as quickly as possible to other countries for real stuff, right? Oil and gas. And this means there isn't any urgency to hold on for treasuries for the long term as well. Then there's the BRICS expansion we have to talk about. It's not a coincidence that half of the new members are oil giants: Saudi Arabia, Iran, and the UAE. Just these three countries alone represent 21% of global oil production, and all three nations trade a ton with China already. So it's just a matter of time before they de-dollarize their energy trade with Beijing, and that means selling oil in yuan and not the dollar. And these are big structural changes. Demand for treasuries from China has changed. It won't be like the good old days when Beijing stacked treasuries all the way to the moon. And as China grows their domestic economy and buys more oil in yuan, demand for US bonds is just gonna disappear. So that is just what China is doing. That is the demand side of the equation for US debt. And it sounds really bad, but it is nothing. It is nothing compared to America's own treasury dump. What China is doing is child's play. They are amateurs compared to Yellen. America is borrowing a ton of money, and to do that, Yellen is dumping a ton of US bonds onto the market. She has released the Kraken and it is going to sink the ship. And here's how crazy it is. For the July to September quarter or Q3, Yellen is going to borrow over $1 trillion. This means $1 trillion worth of bonds is going to flood the market. Then in Q4, from October to December, Yellen is once again going to drown the markets with another $850 billion worth of treasuries. That's almost $2 trillion in total coming. It's simply one tsunami after another crashing down on people. This is why inflation is still problematic and why Powell came up with that ridiculous phrase in Jackson Hole: "We are navigating by the stars under cloudy skies." The Fed is trapped. They can't navigate because the US Treasury keeps borrowing money, and that is countering Powell's rate hike. That is clouding the sky with smoke. And when the Treasury sells bonds, they are taking money from investors and injecting it directly into the economy. And that is stimulating growth, which is propping up the American economy. But they can't pull this off forever because interest rates are going to the moon. Fed Governor Mester is warning that another rate hike is coming for the markets. And here's what she said: "Beating inflation will probably require one more US interest rate hike and then going on hold for a while." And it gets even worse. She believes that her earlier assessment of rate cuts in late 2024 might be too early. She thinks the cuts might only come in 2025 or longer. We are staying higher for longer. And that means our best friend Janet Yellen, the queen of the US Treasury, is going to be borrowing money in a high interest rate environment. She isn't borrowing at 1 or 2%. She's borrowing at 4 to 5% at the very best, and probably much higher. So the real trend is how much higher bond yields can go. China isn't buying, the Fed is selling their own treasuries, and Yellen can't stop borrowing. And this is a gigantic disaster because bond yields are now at a 16-year high. The 10-year treasury yield recently went above 4.3%, putting us back at the '08 levels just before the big crash. And the higher this number goes, the greater the cost of borrowing, and the sooner the US government will hit a fiscal cliff, meaning there's no more room left to borrow, and then they have to make a doomsday decision. Do we default, stop payments, and screw the world? Or do we ask the Federal Reserve to print money and screw the world as well? And either way, it is a disaster and it's already manifesting across the rest of the world. And this is where we need to pay attention to Japan and their treasury holdings. We all know Japan is a US ally. They are part of the G7 and they love America, but even Japan is dumping their bond holdings. Over the past 12 months, Japan has sold off over $127 billion worth of bonds, and that's 20% more than China. What is going on? Is it really because of geopolitical risks? Not really. The reason why Japan is dumping treasuries is because the Japanese yen is crashing. And if the Bank of Japan doesn't defend their currency, inflation in Japan will skyrocket. Check this out. The yen's buying power has sunk to a 53-year low after decades of stagnation. And this means if you are Japanese, you are paying more and more for your imports. Everything is going up in price, especially food and energy. And why is this happening? Because the Fed is hiking rates. And this causes a big difference in bond yields between US Treasuries and Japanese bonds, the JGBs. American bonds are yielding 4 to 5%, while JGBs are yielding almost 0% still. So money is leaving Japan and flooding into US dollars and treasuries. And ever since the rate hikes began 18 months back, the yen has been stuck in a devaluation hell. It has dropped at least 20% against the dollar. And remember that Japan has been liquidating a ton of treasuries to reverse the devaluation, but that isn't working well. They have sold over $120 billion worth, but the yen is still crashing down. And we can expect Japan to continue dumping US bonds, and it's not because they are afraid of sanctions, but because the stronger dollar is destroying their currency. They need US dollars, and the first place they are going to is their treasury holdings. And it is this selling that's going to keep bond yields higher. And this is the domino effect of the global economy. If America keeps borrowing money to spend, and the Fed has to hike rates to clamp down inflation, this causes bond yields to spike up. And this in turn forces countries to dump even more treasuries to raise dollars to defend their currencies. The stronger the dollar goes, the deadlier the situation gets for the US bond market. It's one deadly vicious cycle. So what Powell and Yellen are doing is setting up an epic implosion of the treasury market, either by outright default or by inflating the debt away. And this next chart shows us how dangerous this situation is. Over the past 50 years, foreign holdings of US bonds have been increasing by leaps and bounds. In 1970, it was only 5%, it has grown to 30% in 2022. The higher interest rates go and the higher bond yields soar, the greater the chance of countries selling their bonds. If the pain gets too great, especially if the dollar soars higher, a global treasury dump can indeed happen. So you can see the train wreck in slow motion. The only solution now is to immediately stop deficit spending and halt treasury sales. But there's a big problem with that. It would mean the US economy embracing a recession. And do you really think that will happen? Will Biden really want a recession under his watch? He has been going around the world telling everyone that the US economy is strong. So it is slim to none that he will stop spending, and Slim just left the building. And this is where things get really bizarre and downright hilarious. I'm sure we've all seen Biden's kindergarten presentation of Bidenomics. It's straight from the Twilight Zone, but here's the gist of it. He's going to keep deficit spending up to invest back in America. Now, whether that works or not really remains to be seen. I personally don't think the money will be used wisely, but that doesn't matter, according to President Biden.
Folks, Bidenomics is working, and we're just getting started.
So you heard it, guys, Bidenomics is working and he isn't stopping. So we can expect more borrowing from now all the way until the 2024 elections. And if Biden wins, I mean, at this point, anything's possible, right? If he pulls out the win, deficit spending will go on and on and on. But everything comes to an end, especially when you are borrowing at high interest rates. You will run into what's called a fiscal cliff. It's going to come sooner rather than later. And let's look at two charts that will paint for you the true extent of this horror show. The first is the average interest rate on the national debt. The higher this goes, the higher the interest payments get. And what do we see? It's heading up towards 3% and likely will smash past 4% the longer deficit spending continues. When the old debt starts to mature and gets rolled over to a higher interest rate, we will see this chart just explode up towards 4 or even 5%. And this will make the payments unthinkable. And just how bad will it be? Well, here's the chart for the interest expense versus tax receipts. Just look at this big spike up from 2022. We have gone from under 20% to well over 35%. And this is a nightmare. It means for every $100 in taxes the US government collects, at least $35 goes towards servicing the interest payments. And this means at a certain point, it will become impossible to borrow. It might be at 40% or 50%, and who really knows? But if this doesn't stop, the world will wake up and realize that America is pushing towards insolvency, towards bankruptcy. It's like having your entire paycheck taken away by a loan shark to service your debt payments. Who will want to loan you any more money after that? And this is where things get really ugly. The end game is going to be brutal. And if you think about it logically, it's going to be inflationary. There's absolutely no way America will defund the military or cut entitlement spending. So there's only one ending to this movie: inflation via the Federal Reserve printing money. And the final scene is an inflation hell to save the bond market. And this complicates things because on one hand, this is long-term inflationary, but on the other, higher rates can trigger a recession and that will implode the markets. We can see the bond market breaking the dominant trend of falling yields. We are witnessing a historic end to the 40-year bull market and inflation is here to stay. This is very significant and the market is pricing in that the Federal Reserve will lose the inflation fight. They don't expect Powell to win. And if Biden continues to spend, he could actually delay the recession while bringing us closer to the fiscal cliff. He could actually win the elections. That's why I'm only 40% in money market funds. I'm still buying assets like stocks and gold because we just don't know what will happen. Bidenomics could last well into 2025. And I need to repeat my damn analogy one more time. We have trillions upon trillions stuck in the money markets and short term bonds. As of August, there's almost $5.6 trillion trapped in the money market funds. Both retail and professional investors are waiting out the storm with tons of cash on the sidelines. It's like water stored behind a dam. A huge amount of potential energy is stored just waiting to burst through. And sooner or later, the Fed will have to cut interest rates down regardless of inflation because of the fiscal cliff. If they don't do it, the US government will become insolvent. And when that happens, all the money will rush out and beat up the prices of everything. And this will be inflationary, especially towards asset prices. The prices of everything will rise because now the dollar is trash. The purchasing power is gone, inflation will eat it away. Now, the markets could definitely crash in the next 12 months. I'm still betting on a big correction in the short term, but the bigger guarantee is the inflation problem that won't go away. America doesn't need to worry about China destroying their bond market. They are doing a magnificent job themselves. But let me know what you think in the comments below. Will endless borrowing ever stop? Or are we moving towards an eventual default? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.